Hi, welcome back everyone to Little Saigon Commercial in Orange County. I'm Robert Tran. We are 2 months into 2025, and as the President Trump takes over the White House, we have a clear vision of what's going on for the 2025, and today I'm going to give you the update on the market, as well as the prediction for 2025, so you can plan out ahead of time. We're going to dive down into each sectors and tell you about what's going on. For office, according to the quarter 4 of 2024, the vacancy rate was 21%. The lowest one was quarter 2nd in 2024. It faced a lot of challenge due to the hybrid work and the high cost in the loan put the pressures on the owner for the refinance and for the rent. The retail space is 5.4% vacancy, which is matching 2019 before the pandemic. So we are safe to say that the retail has been recovered. However, there's some change in the dynamic. The high-end retails and the groceries anchor store shopping center are doing very well, but the big box stores are facing some challenge. And there's a lot of renovation instead of new development to utilize the maximum space for the retail, so we are going to see it continue for the next couple of years. Industrial is the strongest sector right now. It has 6.4% vacancy, which is below the pre-pandemic level. It grew due to the expansion of the e-commerce and warehouse and logistics, and the rates of rent has been higher than before, so it's attracted a lot of investors, and it continues to do so for the next couple of years. Multifamily, 5.5% vacancy. It's a very strong sector, and it has always been. But because it's so strong, that is really have high demand, and thus the cap rate is only 3 to 4%, which is super low. And now we talk about the interest rate. Fannie Mae has already forecasted 2025 going to be in line with 6%. From the history, 6 to 7% is a very healthy rate for the economy, and the only reason we see 3 to 4% during 2020-2021 is because of the pandemic, where Fed reduced the cost of money to 0%, so the bank can use that money to lend out to the borrower for 3 to 4% margin. We're not likely to see that number again in the future unless there's a pandemic, which I hope not. So right now you have to calculate the loan with 6 to 7% to factor that number to plan out for selling, buying, or refinancing, so you know what's the best to do for your income, the property. As I said, from 6 to 7% remain in the interest rate going to be the big problem for the commercial real estate. Warren Buffett just sold a major of his stock in the banking companies, which is Bank of America, Citigroup, and Capital One, because $2.2 trillion of commercial real estate debt is coming due. So this is a $2.2 trillion. This is how biggest number is. The loan for the commercial is due between 3 to 7% years, unlikely the residential loan, where it can last for 30 years, or the SBA loan, 25 years. We're not worried about the residential market because 60% of the homeowner has the rate below 4%, and almost 40% of the homeowners are paid off. So we worry about the commercial real estate. There's a lot of people borrow the money from 2020-2021 from 3 to 4%, and now it's become due at 7% if you want to refi. What you can do when your loan is due, you can either pay it off if you have the money, but a lot of people don't have the money now because they already invest the money into the investment, into the business, into expansion, into buying another property. So if you have money, that's great. If you don't have, you can ask the lender for the extension for a short period of time or renew for the same term. But in order for you to do so, you have to go through a lot of paperwork, a lot of steps to convince a lender to tell them they have a reason to do so, to have you to stay in the business. Because if they choose to do so, to renew you with the same rate that you had last time, they at the loss now, which is they will likely to make you to do the refinance. And in order for you to refinance, they will give you a smaller amount loan, so you have to pay out pocket for the difference. And let me show you what the difference is by an example. Let's say in 2020 you bought the property for $10 million with the net of income $500,000. Assume you get a loan for $8 million with 4% interest only. So your debt service is going to be $320,000. And from $320,000, you have the net cash flow equals $180,000. So $180,000 go into your pocket every year. And now with the 7% go up, your debt of service is going to be $560,000. And because this one minus the NOI is 60,000, that means you have to pay negative 60,000 net cash flows every year. It doesn't make sense to the lender. So the lender will only loan you a smaller amount, so you can have money, the NOI, pay for the loan, and then still have some money for the emergency situation where you have to fix a lot of things for the property. And in order for you to calculate the loan amount, you have to calculate the annual debt service equal the NOI divided by the DSCR. The DSCR is the debt service cover ratio. This number can be ranked from 1.25 to 1.55. 1.25 means 125% of the annual debt service going to be equal or less than the NOI, which is $500,000. So in this case, we have $500,000 divided by 1.25. The reason we choose 1.25 for this case, because this is the great property, the multi-retail shopping center. If we go for the riskier property or depend on the very bad area, this number can go up to 1.55. So let's say now the office can go be from 1.45 to 1.55. In this case, we're lucky we get 1.25, so the annual debt service is going to be $400,000. $400,000 means that the maximum annual the lender will allow you to pay for the principal and the interest. Because this one minus this one, you still have $100,000 for the emergency situation. And from this number, you calculate the loan amount equal the annual debt service divided by loan money factor. The loan money factor for this case, we use 7% interest for 25 years on. The equation for this is going to be 0.07 minus divided by 1 minus 1 plus 107 and 25 years. So this is how we get this number to be. So we have $400,000. And when we divide by 0.0857, and so let's do a calculation here. We have $4,667,444. So this is the new loan amount that the lender will give you, and the difference between this ones and the $8 million, you have to bring in $3,333,500 $556. So let's see the amount you have to pay out of your pocket in order to get the new loan, $4 million, 667, and to pay off for the $8 million. And if you don't have this amount, you will be facing a lot of bad situations where the lender can foreclose your property. So let's say for the average loan amount, $5 million, $2.2 trillion divided by that amount, going to be 440,000 property going to face the same problem with the refinancings. So the problem of this person going to be the great opportunity for the other person. If you have cash, the next 2 years going to be the great time to buy property at a good price. And if you have to talk of selling the property, or if you already have the property on the market, if it's not selling, consider talk to your agent to run the comp and to reduce the price. You don't want to wait until you have to compete with other sellers to sell the property. And if you have the problem with the refinancing, please give us a call. We will lay out the option for you to take and to prepare for you, so you not run into the situation where the bank foreclosure. This is the number 714-702-3127. I'm Robert Tran, and we speak English and Vietnamese. So thank you so much for watching the video today, and I hope you the best for 2025, and hopefully see you next time. Bye.